Well, what's up, everybody? It's Caleb from thebookflipper.com. This is part 3 with my good friend Chris.
How are you guys?
And how are things there? We're getting about 10 inches of snow tonight.
Yeah, you guys are getting more. So we've got freezing rain.
Yeah. So if you guys, we'll put links down below, but you can check out part 1. We get into some of the basics of just in general bookkeeping and tracking and making sure that everything is set up from that perspective. Part 2 was the fun one. Although my iPad did not work, I had figured it out. I actually bought a cheap cable, and you get what you pay for sometimes. And I bought a cheap cable, and that was the culprit. And I was in Mexico and did not have my other cable with me. So I'm back in Indiana. We're about to get snowed in. So I expect to be working from home tomorrow, which is the nice part of this business. And we talked all about deductions, sans and iPad. So you just had to watch our ugly mugs. But that was a really good discussion. If you have any questions about mileage and standard deductions and home office expense and everything else that relates to deductions, go check out part 2. And this is part 3. We're going to get a little bit into some of the more gray areas of accounting. And of course, Chris is going to say that everything is black and white. But the reality is there's a lot of gray areas as it comes to laws, obligations, etc. In general, I like to play things by the book, but we'll talk through a couple of those gray areas tonight. And we'll get into a couple things. So the agenda this evening is just like we've done before. We're going to yak at you for 30, 40 minutes. And then we'll take your questions as well. So if y'all have, if you want to drop a note, we're streaming live on YouTube right now, as well as in the Facebook group. And I saw, so Pecan Street Cookie says, or pecan, I never say that word right. They got snow in Austin. So I saw Hayden was getting hammered there, Jason and Melissa as well. So I think that shut down the entire city. You guys get much snow in DC?
Not a ton. We had a couple inches last week, but it's been more rain than anything.
Okay. So Indiana, we kind of know how to deal with it, although it'll probably shut down most of the city. So we'll see. If you're all getting hammered, if you're in the Midwest or in the South or wherever you are, be safe, stay warm. Hopefully you paid your electric bill. As a landlord, you're not allowed to, turn the heat off, but the heating company can turn the heat off, right? If it's snowing. So there's some weird rules out there, but I digress. All right, if you're watching, drop us a line, drop us a like, say hello. Where are you from? Corey Tenney, what's up? I think you just sent me an email. I'll reply back to that later, but we'll work with that offline. So Stevie's here, Rich Colby, Matt Osborne. I think I've heard of you. Rich Colby. So say hello, say where you're from, and we're going to jump in. We're going to talk 3 or 4 things tonight. The first is LLC versus S-Corp. What are the differences? When do we go that direction or not? Number 2 is going to be employee versus independent contractor. What are the differences there, and how does that work if you're trying to scale your team? What are the pros and cons of each of those options? Part 3, we'll dive a little bit into retirement benefits. So for those of you that are able to make the jump and go from side hustle to full-time hustle, all of a sudden you've lost some of your employer matches. And so what are the options that you as the employer can do? And then part 4, we'll talk a little bit about sales tax and some of the fun gray areas that we've dealt with. So hopefully you all are enjoying. Again, if it's cold where you are, hopefully you stay warm. I've got a little bit of water in case my throat gets dry, and a little bit of grape juice that sat out too long and may or may not have fermented. So should be a fun night. We've got Stephen Penny in the house, Chase Locke, Mason Schaefer. I think Chase, you've been on all 3, so good work there. Winston from Maryland and Sharon from sunny Florida. Thanks for rubbing that in. So let's jump in. I'm going to get the iPad plugged in, and it should work this time. And quick recap from before. Anything you want to catch up on there, Chris? I think we kind of hit it already, but as I'm fumbling with the chords, do you want to say anything or remind anybody of anything?
Yeah, so just to recap, Lecture 1, Lecture 2, right? The initial setup conversation, the most important things you can do are really set up something and segregate it from your personal expenses, right? So a separate business account is really the first step you should ever take. And it doesn't need to be a business checking account. It can just be a personal account that you've now allocated to be business in your mind. And then don't make personal expenses out of that account. That's probably the most crucial first step you can take in all of this. The rest falls into place later. Just segregate your funds. It's really important.
Yeah, and again, I'm a big believer in startup. Just get started, minimum viable product. Just get out the door, see if you like it. A lot of times you can get stuck with paralysis by analysis and just get hung up before you even get started. So just get started, flip a few books, get in the hang of it, and before you try and figure out some of these deeper issues of how to hire a team, S-Corp versus LLC, before you go down that path, just see if it's working. And the best way to do that is just to get things separate. What's your bank of choice, Chris? Now that I don't know did I ever get you on the Aslo train? If I did, I'm sorry.
No, we had that conversation though, and I'm glad I didn't get on the Aslo train. I like bigger banks just because they're too big to fail, and so they're not going to pull an Aslo and just disappear on you.
Well, what happened is they're too big and they got bought. So BBVA is probably a Mexican cartel. That's a joke, but they could be. So they're a really big bank down in Mexico, and they owned Aslo. That was their U.S. online portion. And I think they had another system called Simple. They had a lot of good people that, a lot of people loved what they were doing. And they decided to fold both of those because PNC bought BBVA. So too big to fail. I guess the owners took some cash. They had two great online pieces, and they're both going away. Bye-bye. I think I'm going to settle on Novo. I've tried Capital One in the past, didn't really like it. And we'll see. Maybe we'll have this discussion in a year and I'll be switching banks again.
Yeah. Yep.
Novo, I think I was between that and Mercury. And so I was checking that out. Don't laugh just because you've never heard of them.
I haven't heard of either one of them.
All the cool millennials are using these hit banks. So, all right. Well, let's give a couple other shout outs. Rich says it's a high of 10 degrees here today. Brian is watching. Max in Lafayette, Louisiana. Mason Schaefer. Steven in Savannah, Georgia. So lots of good places. Alanthi in Kentucky. There's a snowstorm there as well. Be careful. Jeremy from DC. You got a fellow DCian.
DC, yeah.
I don't know whatever you call them, a district.
Yeah.
What up, peeps? Jeff Barker from Connecticut. Richard Turner from California. And M&A Adventures from Greenville, South Carolina, who we said hello this morning. So thanks for jumping on. Dean from Nashville. Beautiful. And someone asks, how much did Caleb pay in taxes last year? Well, since Trump didn't reveal his taxes, we're not gonna touch that one.
Yeah.
More than $1. How's that? We'll go from there. All right, we're gonna jump in. And I've got, again, this is not sketchy sketches. This is just what I call my notebook because it's my weird sense of humor. So it's an iPad with a little pencil, and we're gonna take some notes. So, Chris, take it away. We're gonna talk about LLC versus S-Corp. Now, You could do C-Corp or some other options, but these are probably the two most common options that someone is going to have, both from a liability standpoint as well as just keeping things somewhat separate. So let's talk through them a little bit if you just want to explain the pros and cons each way, and then we'll talk about, when your business starts to generate a fair amount of money, there's actually some tax benefits and some savings that you can get by going to an S-Corp.
Sure. So first, let's start with just some basic definitions. We're going to talk entities, right? And entities is very different than tax classification, right? So there's really three different types of entities. There's you as an individual, there's you as a business, and then there's a completely separate independent entity called a corporation. So you as an individual and you as a business, right, which is typically an LLC, if you die, the business dies, period.
We had to get morbid all of a sudden, but okay.
Well, yeah. the only standalone entity, right, that exists in perpetuity is a corporation, right? But if you as an LLC and then the corporation, you can elect different tax classifications. So you can have an LLC that's filing in the eyes of the IRS and the state as an S corporation. You can also elect to have that LLC file as a partnership, or you can elect to have that LLC file as a C corporation. You can do the same thing with a corporation, right? So you can have a corporation and elect to file as a C corporation, elect to file as an S corporation, or elect to file as a partnership. So we're talking about different things that very, very often the verbiage gets kind of muddled together and everybody thinks that they're all one thing. So I just want to be really, really clear on those differences.
So when I go to set one up, can I set up an LLC and then just elect to be taxed as an S-Corp?
Yes.
Can I set up an S-Corp and elect to be taxed as an S-Corp, or is that not even a thing?
Yeah. So you would set up a corporation, and the corporation's default tax status is as a C corporation.
Yep.
And you can elect to have it changed to an S corporation or a partnership. The LLC's default tax status is actually as a sole proprietor if you're a single member LLC, so just you. So its default tax status is as a disregarded entity, which means that it's really just you as an individual doing business as something. It shows up on your personal tax return in that situation, which is why it's a disregarded entity. It has no separate tax classification. It's just you on your personal tax return.
So why even get an LLC then? Is there any type of liability? It stands for limited liability company. So yeah. Is there a reason to get an LLC, or should I just have a separate bank and call it good?
No, so the LLC does have a degree of liability protection. All right. So you set up the LLC, you get a completely separate EIN. And really what you're doing is you're preparing for scale. And so this allows for growth, as opposed to another path would be just getting an EIN for you as an individual, a sole proprietor. That really limits your growth. You can't go anywhere beyond a sole proprietor. If you have an LLC, you can grow. You start out as a disregarded entity. You can change it to a partnership. You can grow from there. It just allows for expansion in addition to the legal side of things, that it limits some of your liability exposure. Again, I'm of the opinion that any good attorney can blow up any LLC if they really, really want to. But it's much like just different layers of insurance. If you throw enough hurdles at somebody, you make the low-hanging fruit a little bit more difficult to reach.
Yeah, so theoretically, if something bad happens in an LLC, again, it's a really good reason to have separate finances, because if you start muddling or mixing personal and business, it's called piercing the corporate veil. And all of a sudden, a lawyer looks at that and goes, yeah, you say you're an LLC, but you're not acting like it. You're spending business money on groceries and then sometimes paying yourself back, sometimes not. Therefore, you're not really taking this seriously. Therefore, it's not really a separate thing. And therefore, even though the business only has $5,000 of assets, we're suing you for a lot more than that. We're coming after you personally because there's no separate entity here.
Right.
Yep. So again, this is a good accountant, a good lawyer will both save you money. And usually they're two separate entities because they're very different case laws and examples and understanding of that. Actually, Matthew's looking for a good just corporate attorney in general. I think he might be trying to take me down. But if anybody out there has a really good business attorney, drop some comments down below. Feel free. If you are one yourself, drop a line, drop your email in the comments, or drop your website. It's always good to have some good lawyers. So maybe we'll have you on and do another interview with a lawyer at some point. All right. So LLCs, I know it varies state to state. Colorado is $50. It's very, very inexpensive. You can file it online. It's super easy. And it's just a matter of picking your business name. Usually it has to say LLC after it. So we've got Scout IQ LLC. And then it's very straightforward. I know California is probably a couple $100, $500 to $800 if I remember correctly. I know it's a lot more expensive. Indiana, where I am now, is like $90 maybe. So it's not usually going to break the bank. You don't have to pay for paperwork. Just go to your Secretary of State. You can just Google, Indiana, start an LLC with the state. You'll see a bunch of ads. Don't click on those. They're going to charge you a couple $100 to file the same form that you can file, for the $50 fee essentially. So it's just a matter of picking a name, filing that, and then you need to get an EIN. Someone says Cali's $800. Yeah, that's aggressive. You all should move somewhere else. And you are, you're all going to Austin and Denver. All right. So we get an LLC. We can then choose to just leave that on its own, which by default is the sole proprietorship. Or at some point we can change it. And let's say the business is just starting out. I'm not doing amazingly well just yet. And I decide to change it later. I can change it to an S-Corp later down the road, right? Yeah.
So the initial rule, right? So there's a time frame tied to when you can set it up. So when you first establish the LLC, you've got a window, I think it's 60 days right now, where you can elect to have the entity classified in a certain way. If you're outside that window, the default election would be for the next tax year. right? So you set something up in July, you fall outside the window, it gets to be October, November, you're like, I really want to be an S corporation. The default way to do that would be then file the S election, submit it, and it'll be effective for January 1 of the next year. There is a late S election option with the IRS. It's almost a blanket acceptance because they have such a narrow window tied to when you can set up the initial election. They allow for this path by which you can obtain an S corporation status sort of after the fact. We use that as a strategy with a number of clients, especially as they're starting out and growing. At the beginning of the year, you've got lofty goals of $300,000, $400,000 worth of sales. More often than not, it's much less than that for various reasons, right? Last year was COVID. And so jumping the gun and making the S election too early can be kind of a financial hit. And so we can even wait. We'll file the S election with good cause, and we can retroactively apply it if need be.
Perfect. So let's jump right in then and kind of keep things moving. But let's talk briefly. What are the economics as it relates to LLC versus S-Corp? So they're both flow-through entities, meaning so one of the downsides of C corporations, and most of us really aren't going to be C corporations, C corporations get double taxation. So they're taxed at the corporate level, and then the money that gets distributed to shareholders and owners also gets taxed at personal rates. So even though they're favorable rates at the corporate level, the money does get taxed twice. Right. LLC and S-Corp are both flow-through, which means what, Chris?
So flow-through just really means that it's taxed at the individual level. An S corporation does not have a corporate tax. And the LLC just shows up on your personal tax return. So it's subject to only individual tax rates. The main difference is in how the income can be taxed in the S corporation as it passes through to the individual versus the LLC. And what I'm really talking about here is self-employment tax. And so let's go to just a normal job, right? A typical hourly wage pay stub for a second. When you look at that, you see FICA, you see Medicare, you see state tax and federal tax, right?
And Social Security is included
Social
in FICA,
Security,
right?
Yeah. Yep. And so the employee pays half and the employer pays half, right? And so a typical 9-to-5er doesn't really pay that much attention to payroll taxes. I mean, it's just been kind of part of their lives since they were first employed.
And it comes out of your paycheck. So when they do payroll, all of those taxes and the estimated federal withholding comes out. So you might earn $2,000 in a 2-week pay period, but you only receive $1,400,
right?
Because they're withholding all those taxes.
Yeah, between federal and state taxes, if you've got a state that taxes them, and then payroll taxes, right? That's where that chunk of change goes.
Yep.
The shock associated with self-employment is now you're both the employee and the employer. And so now you have to pay both sides of payroll tax. And this sucks. This is a lot of money. It's a significant percentage.
And this was the big takeaway from part 1. If you guys didn't get a chance to watch, go check out part 1. This is the big piece of self-employment tax. It's not just federal tax. You're going to pay that anyway. It's not just state tax. You're going to pay that anyway. It's an additional 15.3%. It's extra 7.65. It's half of that. It's the employer portion. But because you are both, you're paying both sides of that. So don't forget that when you're factoring in taxes.
Yeah, this is why we say set aside a third, right? Between payroll tax, self-employment taxes, and federal and state taxes. At even a moderate income tax rate, you're looking at about 33% of your money going to taxes in some form or fashion.
Yep. Okay,
Oh, go ahead, Caleb.
No, this is great. So this is kind of the breakdown. So a job, you're paying the tax anyway. Your employer is paying it as well, which if they weren't paying it, you'd like to think they would pay it, to you, which they probably wouldn't. They would keep it. LLC, we're just getting tricked because you're still responsible for all of those taxes, but 15.3% is kind of a big hit when it's not being withheld. So when Amazon gives you that distribution, let's say you're running an Amazon business that's doing quite well, you're making roughly $1,000 a week, just like you did at the JOB, which stands for just over broke. And they're not withholding federal taxes. They're not withholding self-employment taxes. So what Chris is saying is take roughly a third of that, depending on your income level, and a good CPA can help you plan for that. Plan for roughly a third. So if they give you $2,000, set aside a third of that, or $667, and don't touch it because it's going to go away with taxes. Now you can deduct things. So watch part 2, shameless plug for that. You can deduct things, of course, and lower that taxable liability, but plan on roughly a third. All right, which that brings us to S-Corp. So it's still a flow-through entity. It still gets taxed at the personal level. Are there any additional benefits from a liability perspective?
Yeah, so if you set up a corporation taxed as an S corporation, now you have that completely separate entity. There's no connection between you and the business. So if a gaylord of books falls on one of your contractors, right, they sue the business. It is very, very, very difficult to get to you. Again, right? So that's the corporation as the entity filing or looked at from a tax standpoint as an S corporation. The LLC filing as the S corporation, you have the same liability standpoint as the original LLC. The only thing we've changed now is how the IRS views you from a tax perspective.
Perfect. So not much. So to recap, not much liability more liability only if you're not the individual, right? So if you're actually a separate entity as a corporation being taxed as an S corporation, that's the only benefit. If you're just going to be an LLC like I am that has an S-Corp status, that's not really going to do a whole lot of good from the liability front.
Yeah, it doesn't change anything from a liability standpoint. This is very purely a tax play.
All right, so let's get to the tax play. What does this mean?
So what this does is we essentially pull the business off your personal tax return, and we create your own separate tax return for the business.
That sounds like more work, and now I got to pay you more money to do my taxes,
yes,
right?
Okay. Absolutely.
So this is great for you as the tax preparer. So what's the benefit for me as the taxpayer?
Yeah. So when we pull this, all the income and the expenses, the entire activity off the personal tax return, what we do is we create two ways with which you can be paid. You're now paid as the individual. So you could be paid through payroll as wages. The IRS requires you to pay yourself payroll with an S corporation. Now, the next question that comes up here is how much? I don't know. And the IRS doesn't tell you. The term they use is reasonable compensation. So you have to pay yourself a reasonable wage. Well, what is that? I don't know. What they use when they audit you and they say that's not reasonable is they use the Bureau of Labor and Statistics, and they look at the job, the location, the experience, and size of the business, right? So if you're an anesthesiologist in the middle of San Francisco, and your business is producing $10 million a year, you cannot pay yourself $10,000 a year in payroll. Now, why would anybody do that? Well, because it reduces the amount of payroll taxes, right? So 15.3% on $10,000 of annual salary, all right, I can deal with that, versus 15.3% on $130,000 in annual salary. There's a big difference there. So from a tax standpoint, your initial desire would be to reduce the amount of payroll, right? All the way down to zero. The IRS says no. And the reason for that, and what they fall back on, is it must be reasonable.
Yep. So let's break this down. So you're kind of saying you're going to save the 15.3%, but let's back up and explain how that happens. So when you're an S-Corp, again, not a lot of liability protection. This is purely a tax play, as Chris is saying. So you're going to pay yourself payroll. Again, it has to be reasonable. So we'll talk through some examples here. And then two, the other way to take money out of the business is what's called distributions. So the business, the S-Corp, is going to pay taxes on whatever the income is, whether you pay it to yourself or not, right? So if at the end of the year we didn't distribute, all the money, we kept a little bit of a war chest on Scout IQ, just because I didn't pay myself doesn't mean I'm not liable for those profits, if there are any. And so at the end of the year, I'm still responsible for the profits of the business because they flow through to the individual. So it doesn't matter if I pay myself, but if I'm going to pay tax on it, might as well pay myself. So payroll is part one. When I do payroll, I'm still paying because I now am the employer. The S-Corp is the employer, paying me as the employee. So I'm still paying 15.3% payroll tax, right? So just like I'm an LLC. Now, however, the distributions, this is where it gets fun, they do not have the payroll tax. So they have 0%. So the question is, let's say I have a business that sold 250 grand. I had a killer year on Amazon. I end up making about 100 grand of profit, just for easy numbers. So let's say I have 100K profit. Well, if I am a sole proprietor or an LLC, I'm going to pay federal tax on this. I'm going to pay state, and I'm going to pay payroll tax. Federal is going to be the same, whether I'm an S-Corp or an LLC. State is going to be the same. Payroll is where the difference is. So payroll on 100 grand is going to be 15.3%. I'm going to be responsible for $15,300. And if my distributions are now 0, so if this was all on the payroll side, now I'm going to pay $15,000. So the question is, well, hey, I don't mind working. I like it. In fact, it doesn't even feel like work. So why should I pay myself? I'm going to pay myself 0. I'll do it for $1, and I'm going to pay the rest out in distributions, right? If I could do that, then I would actually save $15,300 on my taxes.
Yep.
But the reality is the IRS is going to go, And again, they might not audit you for a while. You might get away with it for a while. But when they do come and audit and look, there's really no limit. Is it 7 years they can go back, or no limit? If you have
they're a vengeful group. And so if you did this intentionally, they can go back indefinitely. And so it depends on how they stumble upon this. It can be anywhere between 3 years and indefinite. So you don't want to mess with them.
Yeah, so don't mess with them. So how do we pick a normal payroll? Well, you can look at BLS data. You can look at cost of living. You can say, look, the average median salary in Warsaw, Indiana is about 40 grand. So that's a reasonable amount. I know some CPAs say you should pay yourself 51% of your estimated profits. There's really no hard line. Again, talk to a CPA, talk to a qualified tax prep individual, and make that decision for yourself. But here's how the math shakes out. So let's say we determined 40 grand was a fair, reasonable, comparable salary in my neck of the woods. If we did that, I would pay 40K over here and 60K over here. Now, again, we're still going to pay the same federal and state on either of them, so we can just take those off the board. There's really no difference. The payroll is going to be the big difference. Now I'm paying 15.3% of 40K, which, just for easy math, let's call it roughly 6 grand. And over here, I'm paying 0 in self-employment tax. So I took my liability, if I was an LLC, from 15 grand of payroll tax roughly to 6 grand. So I saved $9,000 because I'm an S-Corp. Now, you have to have profit to do this. If your profit is only 30 grand, it's going to be a little bit harder, especially if it's a full-time job, to say, well, a fair salary is $15,000 to work full-time in a book flipping business. You could maybe get away with it, but it starts to raise some eyebrows. The other reality, like Chris, you mentioned, you like to see people doing about 70K of taxable income before this makes sense. Why is that?
Yeah, so I like a range of between $80,000 and $100,000. And really, your illustration demonstrates the reasons why perfectly. In order for you to really properly manage an S corporation, right, you have to have payroll, which maybe costs $800 for the year, because you've got compliance filings and quarterly filings and everything else that goes on top of that. So use a payroll company. It's just easier. And,
and I'm a self-starting guy, and I was like, Chris, I'll do it. Wave Apps does it for me. And
how'd that work?
Not real great. I eventually just called Chris and said, I'm sorry, fix this for me, and I'll just pay for a payroll company. And he's like, yeah, I told you.
Yeah. And this, I mean, Caleb, you can speak from experience. This is not something you want to mess with. Payroll is obnoxious. I outsource it. I use a payroll company as well, just because the quickest way to suffer penalties and piss a lot of people off is to screw with their payroll. So just use a company that's all they do. And ultimately that costs money, right? You also have to track your books a little bit more diligently. You need a balance sheet. You need a profit and loss statement, because we have to prepare a completely separate tax return off those financials. That costs money, right? So you pay a bookkeeper maybe $2,000 a year, and they're tracking all your financials, your ins and your outs for you. On top of that, now you have 2 tax returns to prepare, and as an individual, you're probably not in a position to prepare your own S corporation return. You could try, but this is something I would outsource as well. That's usually between an individual return and a business return, you're probably looking at about $3,000. So round figures, that's $6,000 right there.
Yeah, so I'm saving $9K if I'm taxable income of $100K, and I'm now paying $3. So it's not bad. Again, because you're there and you're explaining this to me, I can then take $3K investment and say, this is well worth it. I'm now outsourcing pieces of my business so I can focus more on the core piece of my business. And I have $9K of savings, so now it brings that to $6. It's still a pretty good ROI. Maybe not as good as some of y'all flipping books, but $3K to $9K is not a bad day, not a bad investment.
Right. And I think you would do that all day, right? You give me $6,000, I'll give you $9,000 total. You'll do that all day. But when you think about the math,
I'll do it tomorrow. I'll mail you a check if you're good for it.
But when you think about the math, right, we get closer to $80,000 in profit, and that almost ends up being a wash, right? You're saving $6,000. It costs you $6,000 to do this. Anything below that, right? So starting out as a hobby or a side hustle as an S corporation, you're losing money every time, unless you can really ramp up that profit very, very quickly.
Yeah. And again, just a shameless plug for Chris. He's doing these trainings for free. Matthew always gets mad when I mention free trainings because he says people won't value it. We make our money selling books, selling software, selling some merch. Y'all have some nice sweatshirts out there. We like to give this stuff away for free. We don't have to make money on the training. And that's not a throwing shade to anybody that does it. That's cool. It just feels weird to me, so I don't do it. So we bring Chris on and say, we're not going to pay you. Would you like to give up 3 nights of your busy tax schedule? And so we get to give him some shameless plugs. So you're licensed. You're ready to go in every state.
Yeah. And we're happy to help. We can have these conversations all day. I've had a conversation with a few of you guys who've called recently just watching the videos.
Perfect.
And so this is the strategy we have.
Yeah. So if you're just starting out, if you're way more advanced than even making 80 to 100K, reach out to Chris. He can help you at any stage. And if you're kind of in this sweet spot, 75 to 100K of estimated take-home profit, and you're not an S-Corp already, reach out to Chris. It's going to more than pay for it. You know, he's not going to charge you an arm and a leg. And that's something where you're just going to save the money. You can now have that cash to put back into Bitcoin or books or whatever floats your boat. One other thing that I was looking up on an S-Corp, I think there's a special tax law through 2025 right now where you can deduct 20% of the profit. Is that still in effect? Yeah,
so it's the qualified business income deduction. It's the 199A. And so that actually applies to all businesses with the 2018 Tax Cut and Jobs Act. And so you do get a 20% off the top deduction for business income.
Perfect.
Through 2025. Yeah.
Perfect. Corey says, you love how honest we are. We just like to tell it like it is. Lisa says, so you can tell your CPA. I don't tell you anything, Chris. I ask nicely, but you can tell your CPA to file you as an S-Corp. Kind of. You have to choose that as an election, and there's certain timeframes that you can do that in, right?
Yeah. Any interactions that you have with your CPA should be a team kind of approach, not just a dictator coming in and saying something one way or the other.
Yeah. And then Des says, what are the S-Corp fees in general? Probably depends on the state, doesn't it?
Oh, yeah. So most states have an annual renewal, right? California's $800, Maryland's $300, Colorado, I don't know. It's not too bad. And then tax returns will run anywhere between $800 and a few grand, depending on the size and the complexity. So plan on $5,000 worth of outflow if you own an S corporation. And that's usually pretty safe between payroll taxes and bookkeeping.
Perfect. And one other benefit, I know we're talking a lot about this, but this is probably where most of y'all can benefit. One other thing as it relates to it. So for those of you that have taxes, which unfortunately most of us do, you're supposed to be filing quarterly and doing withholdings and kind of prepaying roughly a quarter of what you're supposed to pay. And so you have those, it's not hard, but it's just one more step to remember at the end of each quarter. When you're doing payroll, it opens up a nice little kind of a backdoor approach. So what we do is I pay myself what it costs to live and have a nice living that I want to have. And then we also overpay that and we withhold the extra as withholding. And so that withholding goes straight to federal and I believe state as well, right? And so I'm actually meeting the obligations and that I do not have to file quarterly anymore because of that. So it's just withheld for me. It's just a strategy we take. We have, every other month or so, we have a call. How's the business doing, up or down? And we just adjust that amount of withholding appropriately. So I still pay myself roughly the same amount that goes into my bank so I can budget and plan accordingly. And I'm toying with doing, probably don't need more distractions, but I'm toying with doing some like personal finance type content. So if you would like to see that, drop me a comment, say you'd like to see it. If not, say just stick to books, dude. But so that's a really nice benefit. And then at the end of the year, if we happen to underpay, we can take our last payment, which we end up doing because I don't plan ahead. And you can take your last payroll payment in December and basically stuff in a ton of withholding and kind of get to a more fair number without paying lots of fees. So that's another really cool benefit. All right, we spent about 35 minutes on that, but hopefully that was valuable and you got some good value there. Let's talk about employees. We're going to kind of speed this up and then take some questions at the end. Let's talk about employee. So you're outgrowing and it's time to start hiring somebody. So employee versus independent contractor. This is an interesting one. So for those of you that are trying to scale up, one of the first questions we always hear is, when is it time to hire somebody? And probably the best thing I've heard, and I've heard this from a number of people, but I'll give some credit, the Wholesale Formula guys. I met them at a small event in Ohio, and they said, look, Caleb, what do you value your time at? This was several years ago. I'm like, I don't know, like 50, 75 bucks an hour, trying to like put a big number out there, right? Like, hey, I'm worth this. They said, cool. Well, what would it cost you to hire somebody to list books for you? It's like, I don't know, 15, 16, 12 bucks an hour, whatever. They said, awesome. Your time is more valuable. You should be spending it doing things that just you should be doing. You should hire someone else to do the cheaper jobs. And I said, yeah, but no one's going to list as good as me. Spoiler alert, most people will list better than me. And so that's kind of a good barometer. But really, if you don't have a lot of profit yet, you should be valuing your money more than your time. And then as you start to ramp up, that equation should flip around. So when it gets time to hire someone, you have these options. You can hire them as a W-2 employee, or you can hire them, I believe it's a W-9 as an independent contractor. So Chris, take it away.
So it's really important to understand the difference here. The difference is in the relationship. So as you're structuring a position, you need to build the relationship so that it is falling into the definition of employee versus independent contractor. The example I always use is a plumber. So when you hire a plumber, you're contracting with an individual to come and do a job. You get to pick the job, right? Hey, do this, right? I want a new sink, or I need a new shower, and then the plumber picks the price, provides their own tools, goes and gets their own materials, says when it'll be done, and then really defines the quality of the end product. They're like, this is it. As an employee, you get to, the employer and an employee, you control the entire relationship. So I can structure my employee's day. You'll do this first, then you're going to do this, then you're going to do this. I structure the compensation, right? We define that ahead of time. I structure the time frame. It'll be done in a week. And I determine the quality. If it's not up to my standard, they go back and they do it again. That's the difference. So when you're considering a role in a position with your growing business, structure it how you want it to be defined. You don't get to pick, right? Oh, I'm going to pay this person by 1099. What we do then is we look at the position, and the position as it's defined dictates whether or not you pay them as a W-2 or you pay them by 1099.
Okay. Now that's a lot to take in. So it's essentially the relationship. Let's talk through taxes. Why would I want to pay someone as an employee versus an independent contractor? What are the benefits to me versus what are the pros and cons to them?
Yeah. So the employee-employer relationship, well, now you've got payroll obligations. You have unemployment insurance obligations. You may have workers' comp obligations. There's a minimum wage in a bunch of different states, right? So you have to pay attention to all of the employer responsibilities. The independent contractor side of things, you're just hiring a plumber. And so really the liability, the responsibility, all comes down on that independent contractor because they're operating really their own business at that point.
Yep. Now, is this at a state level or at a federal level?
So this is defined, it's really enforced state by state. Because the states want their slice of the pie. Yep. This can also be enforced at the federal level, but you're seeing a lot larger state push in the current climate. Yeah,
so check out your state's climate as well.
California,
California, they're trying to, even Uber drivers are trying to say our employees. So be cognizant of where you are. This is kind of one of those gray areas. So as the boss, I would prefer to pay someone from a strictly financial standpoint as an independent contractor. Because if we agree, or if they say, hey, my rate to come list books at my own time is $15 an hour, then I just pay them $15 an hour. There's no payroll obligations for me. Now they're responsible. So I'm pushing that. Someone's going to pay the payroll taxes. If I don't pay them as the employer, or I don't do payroll and set all that up, then they're going to be obligated to pay the full employer and employee side, just like we talked about. So they're the independent contractor. They're essentially an LLC. They're going to pay the 15.3% tax. If it's an employee, I'm going to pay 7.65% of that. And then my payroll is going to also withhold 7.65 from them. So if you do want to, because of liability and some other issues, if you're comfortable making that decision, and your CPA and your legal team and everything else can kind of help there. If you want to set them up as an independent contractor, a really nice thing to do is to pay them an extra 7 to 15% and help them understand that they're going to be responsible for all of those taxes. And because of that, instead of $15 an hour, bump that up another 10 to 15%, because you're not withholding it, and they're going to get hit if they're not sure what's going on or familiar with the process. They're going to get hit with that unwelcome tax burden at the end of the year. So if there are certain reasons, so I'm an S-Corp, I want to actually pay one of my guys as an employee right now. We're having this discussion. There's some other things we don't really have time to get into, but because I'm an S-Corp, I pay myself certain retirement benefits, healthcare benefits, et cetera, through the business. If I'm going to have employees, they are also entitled to those same benefits, which all of a sudden starts to get a little more expensive to bring an employee into play. So we're going to be doing some, shuffling of some business entities, and we'll figure out a good strategy. And Chris and I are kind of working through that. But in the short term, he picks his hours. He actually is a bookseller on his own. He can go out anytime he wants and just work for himself. And, a couple of days a week, sometimes he's like, hey, I'm not going to be in. I'm going to go find my own books. Perfect. That actually helps my case, because he's choosing some days to come and work at whatever wage he's established, and other days he goes out and flips books. So it's not like I'm his only job. That actually helps that case for him being an independent contractor. In response, I told him, hey, I want to pay you this much, and I'm going to pay you more than this much because of payroll taxes that you are responsible for. So I'm not saying that just because I'm a nice guy, but help your people that are important to you understand what's going to come due at some point. Okay, so that's the employee versus independent contractor. Anything else on that briefly, Chris?
No.
All right, let's talk retirement. So when you work for a company, there's a couple things. So let's talk through kind of the stair steps. So the first thing you want to do is set up an IRA. You can do that whether you work for a company or not. And that's an individual retirement account. There's two different versions. One is just a standard traditional Roth.
Yep.
So you have traditional and then a Roth, which I wish my family got some royalties from that, because that would help, but we don't. So a traditional IRA, you put in, you get a deduction. So it's after tax dollars. Sorry. Before. You put in pre-tax dollars. Yep. And
they sit untaxed.
And they sit untaxed. And as they grow, you eventually, when you pull them out, you pay taxes later on the entire gain, right?
Yes.
So they're,
yes.
Yep. And you're deducting that today to save on the taxes.
Yes.
And then you kick the tax burden down the road.
Yes.
And an IRA, what's the max in 2021? Like $6,500?
Yeah, $6,500. They increased it a little bit most years. And then if you're over 50, you can do another catch up there. So there's a little bit more you can add to it.
All right. So I can put $6,500. You can elect to do this traditional or Roth. There are some income phase outs, at which point you can no longer do a Roth. So check the tax laws, talk to your CPA. A Roth, I'm going to pay the tax. I'm going to, the government's going to take their cut. I'm going to put in after-tax dollars into the Roth, and they're going to grow tax-free. And when I decide to pull them out, I get to pull the gains and the principal and everything and not pay taxes later. So you can there's whole schools of thought. You can Google it. There's all kinds of good research on it. But in general, an IRA is something that you can have whether you work for a company or individually. And it's the first step. If you're going to put any retirement dollars in, pretty much start with an IRA. Vanguard's got some amazing funds. They're really low cost. If you don't know anything else, basically go find an index funds. They've got retirement years. So just pick, hey, I want to retire in 2050 or pick a year. And they'll actually allocate everything, average cost. There's all kinds of stuff. We won't get into all that discussion. But an IRA is the first step. All right. Companies then usually have, 401ks?
Yeah, depending on the size of the company, right? The 401k seems to be the most familiar and popular, but that's actually, it's usually tied to mid-sized and larger companies. School entities, right? You'll also see a 403b if it's a state entity or government entity. You have different options. It's essentially the state equivalent to a 401k.
Yep.
Those are your pre-tax, usually retirement accounts. So you get to put money in. You don't pay tax on it in the current year. It can grow, but then you pay tax on the whole amount when you take it out, hopefully closer to retirement.
And the max there is about 15K?
It's 19,500 this year.
That's been going up, huh?
Yep.
Cool. So government will let you put that much money in. Again, you get the tax deduction. So there's some incentives. They want you to save, even though 70% of our GDP is consumer spending. Somehow they've decided that they'll let us save a little bit for retirement, which is awfully nice of them. So if you don't work for an employer, usually they'll match. And if you guys still have a day job and your employer is matching anything, that's free money. So a lot of times they'll let you put in like up to 6% of your paycheck, and they might match 100% up to like 3 or 4% or 50% up to 6%. If there's a match and you're working for a company, by all means, throw that money in there and let them match. That's literally free money. So do that. If I work for myself, 401k is no longer an option, correct?
You can set up a solo 401k. It is an option. It's a lot easier with other entities, right? The S Corporation would be a great entity by which you can run this, because now you've got payroll that you can run it. There are programs where you can actually do this as a sole proprietor. The math gets a little bit weird, but it's out there. Usually this plan is a little bit more expensive, a little bit more complicated than some of the other retirement plans that are out there. But it's a phenomenal option because now you can do the employee contribution, the 19.5, and the employer match. So the math comes out, you can actually contribute closer to $56,000, $57,000, depending on the year, into a retirement account each year, if the math allows it, right? So if you've got a profitable business, you can put the 19.5 in as the employee side, and then the employer match can get you up to the 56 grand.
So for those of you that believe in the FIRE movement, if you're making that 80 to 100K and you're able to live on, 25 or 30, like Mr. Money Mustache, that might be a really good option just to stuff a bunch of money. And there's calculations based on your income level and how much you're allowed to put in and everything else. So again, consult someone that's experienced, a la Chris, or somebody else that you know and trust. Any other options? There's like a SEP IRA, some other options as well.
Yeah, the SEP is another option. This is a little bit straightforward, or a little more straightforward from a math standpoint. It's depending on the type of entity, either 20 or 25% of your net profit can go into an IRA pre-tax, right? So you get to deduct this off your tax return, and then it grows, and then you pay tax when you distribute it out closer to retirement.
Perfect. So again, in recap, and again, I don't want to get into too much retirement advice. There's tons of really smart men and women that are actually doing all kinds of content on this. Go find them. Research the FIRE movement, FIRE, financially independent, retire early. There's some crazy people in that space, but a lot of really smart people as well. So in general, have the IRA, start with that. You can set those up through like a Charles Schwab or like a Vanguard. Vanguard's probably one of the more popular ones. Very low fees, et cetera. As your business starts to grow and as you step away from a company and a 401k is no longer an option from the company, then we start getting into some of these other discussions. So there still are ways that you can have tax advantage ways, meaning it lowers your taxable liability today, and then you'll pay the tax later, which we can argue whether tax rates are only going to go up or down. But in general, you can save some extra money, which will lower your tax liability, which means more money to put into your business, as well as there's some cash sitting there that hopefully you can use in retirement. So with that, we got about 10 minutes left. And Chris, are you good to go a little longer today?
Yeah, that's fine.
Perfect. We'll take some questions since this is our last option. This is our last one, is part 3, and pretty much everything has 3 that's any good. So this will be a trilogy. We won't work into a quadrilogy or whatever that would be. So let's talk sales tax, shall we?
Sure.
This is the fun one. You don't sound real excited.
No, it's a pain in the neck.
All right. So I'm going to say a couple things here because I know Chris's probably hands are a little more tied as it relates to this. This is an interesting fuzzy area, and up until it's getting better and better for sellers. So here's where it gets interesting. If you are like I lived in Colorado, if you sell merchant fulfilled and you own all the inventory, it's sitting in your house or your warehouse, and you ship things out, you just pay Colorado sales tax. So you're supposed to register in Colorado. You're not the end user, which actually gives you some benefits when you go to the thrift store. You can have a reseller license with you and say, look, I'm buying these. Some states call it a wholesale license. I'm buying these items to resell. Therefore, I'm not the end user. And you can actually get the sales tax waived at the point of purchase, which saves you 6, 7, 8%, depending on your state. When you sell it, though, when it sells inside your state, you're supposed to collect, remit, and pay that sales tax. So you could, on Amazon, you could set it up and say, hey, I'm a Colorado resident. I want you to charge the sellers that amount of money, and then we'll go from there. Let's see if we can make this really big here. All right. And what it gets interesting then is, were you technically responsible, Chris, if it's sold outside the state?
So each state has its own rules. And really the question is, do you have a nexus, right? A business nexus, either because you sold a certain number of things that now triggers the nexus, or you sold a certain dollar value of things that now triggers the nexus. Every state's different. But that's the question that you have to ask. If you have a nexus, then yes, you have a sales tax obligation.
Yep. And the nexus, we won't get into. Every state has different rules. Sometimes you have to sell $100,000 of product into a state to qualify for nexus. Sometimes it's a unit option if you have 200 transactions or 150 transactions in a state. And then the third part, which got a little hairy with FBA, was if you have a physical presence in that state. Well, our inventory as Amazon sellers, FBA sellers, gets distributed to lots of different states. So if I'm a small seller doing merchant fulfilled, most of the time I'm not going to have nexus because I'm not shipping 500 items into California, or I'm not selling 100 grand in Vermont. But when my inventory is now distributed, there's some arguments, and there was arguments either way, and some of them were good or bad. There were some arguments either way saying, well, if you have inventory stored in a warehouse in Illinois, all of a sudden you have a physical presence because your inventory that you own is there. And so therefore you're responsible for state sales tax, even if you don't meet these 100 grand or 200 unit type setups. So that's where it started to get hairy. Now, the reality is, and this is something that, companies like Avalara or TaxJar and some of those companies, you'll see them putting the scare tactics on, saying you got to pay for their software and track everything and make sure that you're paying every last penny, which the letter of the law probably says that, although there's case law either way from what we've seen as it relates to physical presence in those states. So what's going to happen is the states have to decide, hey, we're going to knock on Amazon's door, subpoena them, and ask for the names of every seller that sold an item into our state, and then figure out who owes us money. That sounds like a lot of work, and governments aren't usually that efficient. Although people that own toll roads are, surprisingly, but I digress. So governments aren't crazy efficient, and that's usually not worth the squeeze because they're going to have to spend a lot of resources to come after small sellers. So you were supposed to be filing and doing that, but the reality was they're probably going to go after the big players. And the best way for them to do it in an efficient market is they're going to go to Amazon and say, Amazon, you need to be collecting and remitting. You're just letting all these third-party sellers, which we now make up more than half of all the sales on Amazon, you're letting all these people run rogue, and you're not really educating them that they should be doing these sales tax pieces because they may or may not have nexus. And, shame on you. So instead of going after hundreds of thousands of third-party sellers, the smart states just started going. We saw this, 2, 3, 4 years ago when they started?
Yeah.
So some of the states immediately popped up and said, all right, Amazon, you're responsible. And I think there was probably lawsuits involved to get this to happen. And they said, we're going to impose a marketplace facilitator tax. And Amazon, you as the third party or the platform are responsible for collecting. So one by one, states are jumping in. And as soon as Texas saw what California was doing, they said, hey, they're getting all this revenue. We want it too. So the nice part for sellers is this kind of just fixed itself on its own. So over the last couple of years, I believe we're up to, I just counted, I think we're up to 41 states that now Amazon is the seller of record. They're the ones that actually collect, remit, and pay that tax, which means we don't have to do anything. Of the remaining 9 states, or 10, depending if you count DC or Puerto Rico or any of the other fictitious states that potentially are out there, of the remaining 9, 4 of those don't have a sales tax. So I think Oregon, Montana, New Hampshire, and Delaware maybe. So there's a couple states that don't have sales tax, so nobody's really responsible there anyway. And so there's just a couple holdouts. I think Missouri, Kansas, and Florida are the notable ones where there's a little bit of some issues there. So what are we supposed to do in those particular states? So this is kind of where it gets a little bit hairy. So Chris, letter of the law, we're probably supposed to be collecting sales tax in those remaining states, correct?
Yeah. And so in all these instances, Amazon will collect and remit the sales tax on your behalf. But you have to have the sales tax account number in order for them to apply it appropriately. And so in these remaining states, the job falls on you.
Yep.
So if you have a nexus, now you have to register and obtain a sales tax account number. And then from there, you file usually quarterly. But it can be monthly depending on the frequency, or it can be annually if you're just a small taxpayer. And you submit a sales tax return, right? I sold this many books at this much cost in your state, which says, now, according to the math, I owe this much in sales tax. Here it is. Apply it to this account number and consider me paid in full.
Yep. Now, if I don't want to pay it, let me switch my iPad out. I'm running low on battery, and I've used all the ports on my MacBook. Cue all of the conversations about not having MacBooks. Hang on one second. Okay, so I'm supposed to pay these taxes. Now, if I don't go through the hassle of recording the taxes that are due, is there any other options that I have? Sorry about that. Like, can I just not collect it from the sellers and then just actually file it at the end of the year and just pay it myself?
Yeah, you just pay it out of pocket, right? Yeah. So nobody cares where the money comes from, right? They just want the money. Yep. And so ultimately, if you withhold it from the buyer, that's fine. It's still due. And if you don't withhold it from the buyer, that's fine. The state still wants it. It's still due. So just write the check.
Yep. So for those of you, and again, this is where you can have these discussions. We could tell the California story if we want, but states sometimes go on these witch hunts and they're going to try and track it down. And again, I try and be as black and white as possible, but a lot of times the costs of actually tracking everything and paying those amounts out is just more than I'm even going to pay them when it comes to the actual taxes that are due, depending on the level of your business. So you can kind of make those calculated decisions. If they end up, catching you at what we kind of decided and we kind of move forward with was, look, if they catch us, cool. And we kind of saw the trend coming down the pipe of all these states just saying, Amazon, you're going to collect it anyway, because it's way easier to go after one entity. So Amazon, eBay, the main platforms are going to be responsible for collecting it. And we just saw the writing on the wall and said, look, it's going this direction. That's going to be the process. And it actually has panned out. And I would bet those last couple states that are holding out will eventually just jump on board and do that as well. So as Rich says, it is risk first reward. Those are some of the, I hate to say gray areas, it sounds bad, but those are some of the gray areas as it relates to business. And, if my opinion, if the government wants to make, us to pay them, make it easy and we'll do it. Don't make it super complex like the tax code. We should simplify that. But again, I digress. All right, we're going to take some questions. We're right at an hour. We covered all 4 things we wanted to. Hopefully we cover them satisfactorily. We're going to take a couple questions. If you guys have them, comment either on Facebook or on YouTube, and we will take a handful of questions. Chris, thanks for your time. Thanks for jumping in. I hope I always learn something. Hopefully it was helpful for those that were watching. And where can people find you as we get into the last couple questions here? Yeah,
website is fidelistaxandaccounting.com. So FIDELIS tax and accounting. Boom. And so we're happy to help. You can actually schedule a an appointment with me directly through the website, or reach out. We'll get back to you. We'll set something up. We can hop on the phone and talk.
Perfect. So reach out. Chris is happy. Again, he can work in any of the states, and he's more than happy to help you. If you're watching and we're like, hey, I really need to get the S-Corp ball rolling, Chris is your guy. He'll help you get set up. So let's take some questions. And if there's no questions, we'll move from there. Rich says, great call. Thank you. He also says anyone can be audited, but they're not chasing the small fish. Kind of. Again, the penalties. I mean, what are we talking, Chris? If you get audited and you're kind of doing some shady stuff, is it prison? Is it death? Is it electrocution? Is it penalties? I mean, like what are we talking?
Anything from a slap on the wrist and a small penalty that you can get waived, all the way up to prison time. It depends on what you're doing. You do not want to screw up on the payroll tax side of things. There's 100% of the tax due is a penalty that they levy on top of you paying the tax. So don't mess that side up, and everything else we'll figure it out.
Yep. Dean says, once I set up my LLC, I quickly got a letter from the state. They're on to you, saying I now have to register and file a franchise and excise tax return. Are you familiar with that one, Chris?
Yeah, they're very, very similar to just the annual filings, right? There's always a minimum. California is the $800 minimum. It can be a lot more than that. But yeah, it's annual compliance, and then you usually have either sales and use or a personal property tax return that gets filed in conjunction with it.
Perfect. He goes, could it be more than $100?
Absolutely.
Yeah. So again, make sure especially if they're reaching out to you, they know that you exist. So make sure that you are being as compliant as possible. And even the states, like when I was in Colorado, and I'm very delinquent when it comes to my books for whatever reason. I understand what I should be doing. I just don't have the discipline or the focus to do it. And Chris, I think I cause him a little bit of gray hair every year. I'm sure I'm not the only one. When you don't pay your taxes, the friendly tax lady actually shows up at your door with a note that says you need to pay these. So don't let it get to that level. Just pay them. And they're super nice. It's real people behind a desk. Most people don't like them. So I'm sure it's a tough job and they have to have thick skin. They're usually pretty kind, but don't make that happen. Okay, a couple questions. This is a deeper one. Again, Facebook use there. If you have to provide a book lister training on how to list books, is that a contractor or employee? So let's talk through he's got a couple, or he or she, I don't know because they didn't log in, have a couple questions as it relates. So if you're doing the training, that's probably going to push them more toward employee versus contractor.
I don't train a plumber.
Exactly. So, and again, this is not super cut and dry. Some states are going after it more than others. In general, the more boxes you can check and say that they're more of an employee or more of a contractor, then the stronger your argument. Again, just like paying yourself when it comes to LLC and S-Corp, what's a reasonable salary? Well, it just depends, right? As long as you can make a good case for it. So let's talk through it. If you're going to be training them, it's probably going to push them more along the lines of employee because you're the one that's controlling the relationship. So as you said, it's different from the example of the plumber because someone is already skilled. Another question, you have someone sourcing books for them. You're providing them with Caleb Scout IQ. Thanks for that. App. Are they a contractor or an employee? You're paying for the app. Well, if you're paying for the app, that's more control from you onto the person doing the work. That's going to push them more along the lines of employee. If you're providing their supplies, if you're providing, they have to work in your warehouse, all of those things are going to push it more the direction of employee, right? So if, the more that they can set their schedule, especially if they have other sources of income, that's really going to help your case. And if they provide their own supplies, if they provide their own, they should pay for their own app as well. Because the more things that you're doing for them, it really weakens your case, assuming that you want them to be classified as an independent contractor.
Yep, I agree.
Creative Cinema says, so why pay yourself more to cover the taxes versus reducing your pay and taking more as a disbursement? Chris?
So this is fun, right? There's conflicting sort of goals here. But remember, the math on the maximum contributions for retirement accounts is heavily based on the amount that you run through payroll. So sometimes it is strategic to eat the payroll tax because now you can increase the amount of pre-tax retirement contributions you could put into an account.
Yeah. So again, there's all these. It's not just cut and dry. It's not just S-Corp, so payroll versus dividends. There's also other things in play, which Chris mentioned. So again, the more you talk to someone that's qualified and explain your situation, how much money you're making, how much money you think you're going to be making, and what your goals are as it relates to retirement, hiring a team, insurance, all of those things, the more they can help you move around those variables and make sure that it fits your particular situation. Okay, a couple other questions here. We got a whole bunch of stuff about selling the steak, not the sizzle. There's a whole side conversation on FBM versus FBA. Diane, we'll try and get some tax question. What's the waiver called for the smaller penalties?
It's a penalty abatement. There's different rules tied to the waiving of different types of penalties. Usually the IRS will give you one freebie every 3 years, as long as you're in good standing and otherwise compliant.
Perfect. This is a good one. Can you deduct your contribution that you put in your Roth IRA?
No, the definition of a Roth is you want to pay tax on it now, and that keeps you from paying tax on it later.
Yep. And so you're basically going to pay tax on a chunk of money either now or later, right? With the different IRA options. A traditional Roth, you get the deduction now, so you save the tax now, which means you'll pay it later. There's no way to have your cake and eat it too. Although if you watch, I forget what show it is, the phrase was actually the other way around, which makes more sense. You can't eat it and have it, but we've switched it back around. So you're going to pay tax one time, right? You're either going to save the money now in a traditional Roth and pay the tax later, or you're going to pay the tax now, put in after-tax dollars. You can't deduct that then in a Roth IRA, and you get to save on the taxes later. So those are the options. Stevie asked, why are people on Facebook? It seems like a good place to be. Trevor says, thanks. Oh man, I'm losing the context. Here's a good one. You can incorporate in any state. Does not have to do with your residence, i.e. Delaware. Shop around for the best place. Is that actually an option, Chris?
Sort of. You're right. You can incorporate in any state, but you also have to register in the state where you have a business nexus. So you can incorporate in Delaware. Great. If you live in Colorado, you still have to register in Colorado as a foreign entity doing business in Colorado. Now you pay annual registration fees in both states. So
again, there's lots of cool ways to play the tax game, but again, make sure that typically the games don't work unless you're making a fair amount of money, right? Because it costs money. As we said, to file an S-Corp is going to cost you an extra $5,000 just in payroll, bookkeeping, extra tax filings, the setup, maintenance, etc. So if you're not making much money, there's really no reason to play that game. You can always do it later. Creative Cinema says, is there a max to what you can deduct for charitable contributions, ties, etc. as an S-Corp? Well, first off, the S-Corp can't be making the charitable contributions.
Yeah,
right?
you don't want to do that simply because it's detrimental to other tax situations, right? Charity doesn't get, or it comes off your 199A qualified business income deduction. So you reduce that amount that you can get 20% off of. So your ties, contributions, and everything else, it serves you better usually to do that as an individual. If there's a way to make to make those contributions, right, an advertising expense. So a sponsorship with the Special Olympics we did with the client is now a business expense rather than you just writing a $500 check to the Special Olympics and it's just simply a charitable contribution. Turn it into a sponsorship, and now it's advertising for your business.
Yep. So there's ways, again, to be creative. Is there a max? So if this is a side hustle, let's say you don't need the income, you make 20 grand at the end of the year net tax. Can I, instead of paying tax on that 20,000, can I literally just give it all away?
You can, especially last year. So the CARES Act allowed you to contribute up to 100% of your AGI. Typically, it's 60%. That's the most you can go. And then if you contribute or donate above that 60% of your adjusted gross income, it carries forward to the next year.
Perfect. So yeah, there is a limit. One thing, if you're trying to be really generous, which is awesome, you could actually check out a donor advised funds. You can get those through Vanguard or a number of places as well. That's a pretty cool vehicle where you can say, look, at the end of the year in December, you're like, oh, I didn't do my planning because I'm scrambling and I need to make those deductions before December 31st in order to have them qualify. I didn't do my homework. I don't know where I should give the money. I want to make sure it's a good investment or a good, stewardship of the funds. Where do I put it? A donor advised fund is a really cool vehicle where you can set that up. There's some limits. I think it's 15, 25K to get started. And you basically put it in the market. So it can grow in the market and you allocate those funds. So instead of giving them to a college or a charity or church of your choosing, you put in the donor advised funds. Once you put it in, the moment you put it in, you get that deduction for tax purposes in the current year. and you can kind of keep it there forever. You can never pull it back out for yourself. That's a big no-no. It's illegal. You can't do it. You have to then give it to a qualified, 529?
Yeah, 501c3.
501c3. 529 is college savings plan.
Yep.
I digress. So 501c3 has to go to a qualified charity, and that's a really cool option. It can actually then get market appreciation in the stock market, bond market, wherever you'd like it to sit. And then you can save up and kind of do that. And there's some cool tax opportunities where you could kind of load that if you have the cash to do it. You could load it up in 1 year. The next year, don't put anything into it. Pay all your charity, tithe, everything out of the donor advised funds. And you can take the standard deduction in year 2, load it up in year 3, take the standard deduction in year 4. There's some cool things you can do. And again, all of this to say, find a good accountant, find a good tax person as far as that goes. 1 or 2 more questions, and we will let you all get back to your evenings. Chase says, if I pay a prep center, do I need to consider that a 1099 or a service and just deduct as a fee?
So anybody that you're paying for a service, unless they are filing an S corporation or they have Inc., right, incorporated, fully incorporated at the end of their name, usually you need to think about a 1099 for them. One of the cool developments in the last couple of years is if you pay somebody through an electronic medium like PayPal, then you actually don't need to 1099 them because PayPal will issue the 1099K. And so there's no need for redundant reporting in that sense.
And a 1099 is just a way to tell the IRS, hey, I paid such and such person this much money to do this task. And that just tells the IRS to go looking for that person to say, hey, you paid them $2,000. They need to be reporting that they made $2,000 from you.
Yep.
So again, if you pay through PayPal, that's a pretty cool thing. So instead of your now defunct RIP Aslo Bank, you could pay someone through PayPal. They're going to actually do that paperwork for you, which is nice. Right. And that paperwork, by the way, is due at the end of January. So if you haven't done it yet, you're behind.
You're late.
You're late. And if you're late, you're dead. Brian says, do I have to do payroll if I'm just a sole proprietor LLC? No. Can I even do payroll if I'm an LLC? No. So don't do that. It just flows through. You are the business. It's just going to come to you. You're going to pay the tax. There's no benefits to doing payroll. Don't deal with it.
It'll complicate your world.
Exactly. 1 or 2 more. In a consignment relationship as the seller, are you paying tax only on the commission portion and the client owns the inventory? How does that come? Probably asking as it relates to sales tax, who actually owns it? That's going to get hairy.
I don't know if I fully understand it.
So I think they're asking, one would be, there's 2 things I could see here. One would be, what's the sales tax obligation? Well, you as the seller need to be doing that. Now, you could say it's their inventory, but you're kind of responsible for it. So I don't know that gets you out of that situation. But are you paying tax only on the commission portion? So let's say I sell $5,000 for a client. We have $35,000 of profit. I've got a 50-50 split. So I bring in $17,500 to me. They get $17,500. Did I have to pay tax on the full 35 that flowed through to me? Or can I push that tax burden to them?
No, you push it. You pay the tax on the income you keep.
Perfect.
Right? And so ultimately for you, that commission that you pay out to the consignee, right, is an expense.
Yeah, it's a qualified deduction, right? It's a cost of doing business. You're not stuck with that tax bill. That would hurt.
Right.
This will be interesting. Maybe we won't touch this one. Canadian doing business in the States, living in Canada, shipping FBA, merchant fulfilled. Do I have to file anything in the U.S. or just claim income?
Yes.
You're not licensed in Canada, right?
I'm not licensed in Canada, but this is a U.S. tax issue. So you have a U.S. tax obligation. You are making money in the United States. You have a nexus in the United States. There's a filing requirement there.
Perfect. And that's a hairy one. You definitely want to find a good qualified person. All right, last question.
The US side and the Canadian side.
Yeah, last question. Richard Turner, this is a good one. Do I pay taxes on my profits if I decide to reinvest 100% of them back into the business? Or do I pay them once I pull money out?
You pay tax on profit. And so it depends on by reinvesting, right? Are you buying inventory? Are you spending it on expenses? If you make $10,000 in profit and then you go buy $10,000 worth of business essentials, not inventory, but maybe a computer, then no, there's no profit left. You spent it all. If you spend that $10,000 on inventory, you still have to pay tax on that $10,000, right? Because you can't deduct the expenses on the inventory until it's sold. That's the cost of goods sold part of things.
Yep. So bottom line, make sure you're tracking things separately. And again, we'll have parts 1 and 2 posted below. They'll just be in the channel. We did them in the last 10-ish days. I think we did February 4, 9, and 15. Chris, thanks so much for your time. Everybody that was here, thank you for, I know these are not popular topics. I'm sure you saw the emails and the comments and we're like, I should probably pay attention, but that sounds complex and like it would hurt my brain. And so I'm just going to go watch Netflix tonight instead. That's fine. These are recorded. They're going to be out here. You can watch them when you're in a better frame of mind. So Chris, I really appreciate it. Can't thank you enough for your time. Hopefully this was helpful. And if you want to find Chris, Fidelis Tax and Accounting, he will take great care of you. I keep trying to say we should get an affiliate relationship going. I don't even make a penny if any of you go to him. So you can tell him I sent you. Maybe he'll buy me an extra beer next time we hang out. But Chris is a good dude. He'll take care of you. And I appreciate you jumping on.
All right. You guys take care. Thanks, Scott.
All right. Have a good night, everybody.